Welcome everyone to another fresh deep dive.
Great to be here.
Today, we're wading into the latest daily financial briefing. Global markets and digital assets outlook.
hmm
Our mission really is to help you cut through all the noise.
Yeah.
We want to take, recent market moves, policy stuff, tactical opportunities,
Yeah.
and just sort of break down that complex financial data so it's much easier for you to digest.
Quick sense of it all.
Okay, well, let's unpack this then. This past week finished a bit mixed for global markets overall,
Right.
but, and this is the key thing, we saw some really significant upward momentum in U.S. stocks, and maybe even more exciting for many, the digital asset space just kept climbing.
It really did.
So here's where it gets really interesting, I think, for understanding what's actually driving things.
Exactly. And this deep dive, it's really designed to give you a clearer picture, a structured way to understand what's happening under the surface.
Right.
Our goal is always to help you spot the patterns, connect the dots from the briefing, like the one from July 18th, 2025 we're looking at.
Okay.
So you get not just what happened, but why it actually matters for your own perspective.
Mm-hmm.
And what's fascinating here, truly, is this, interplay. You've got surprisingly strong economic data from the U.S.
Well, resilient.
But the dollar actually slipped back a bit, which let other currencies recover some ground.
Okay.
And all this is happening while digital assets are just, well, euphoric isn't too strong a word. Total crypto market cap pushing past $4 trillion for the first time.
Wow.
It's not just numbers. It's about getting a handle on those underlying forces.
Absolutely powerful forces indeed. Let's maybe start with equities.
Yeah,
Because U.S. stocks, like you said, just kept chugging along.
you really did.
The S&P 500 actually logged its sixth record, close in 8 sessions, finished up over 0.5%.
Impressive run.
And the NASDAQ 100 gained even more, about 0.75%.
Right. Tech leading the way again.
Yeah, propelled by those usual suspects, right? Semiconductors, AI companies, plus some better-than-expected retail sales data, good outlooks for earnings.
Right.
Even the Dow Jones managed to extend its gains, despite, some pretty serious tariff threats flying around.
Yeah, that was notable.
It really sounds like investors were just sort of shrugging off a lot of potential bad news, wouldn't you say?
They certainly seemed to be. And if you look over at the bond market, specifically the U.S. 10-year Treasury yield,
Okay, all right.
it stayed pretty much flat, right around 4.35%,
Interesting.
which tells us investors are still balancing those two big ideas, strong economic growth on one side,
Right.
and the Fed may be possibly delaying rate cuts on the other.
The eternal balancing act.
Exactly. But what's really noteworthy is how credit spreads tightened.
Okay, explain that a bit more. What does tightening credit spreads mean for us?
Sure. So think of it like this. It's getting cheaper for companies to borrow money compared to the government, which is seen as super safe.
Oh,
So when these spreads compress or tighten investment grade down 3 basis points, high yield down 9 basis points,
okay.
it suggests investors are feeling more confident. They think companies are less likely to default on their debts.
Ah, so it mirrors that confidence we saw in stocks.
Precisely. It fits that whole risk-on mood. Capital feels okay moving into slightly riskier things.
Oh, that makes a lot of sense. The confidence spills over. Okay, shifting gears to commodities. A bit of a mixed picture there.
Yeah, a little bit. Oil, WTI crude specifically, was down about 1.5%. Seems like demand worries won out over geopolitical risks for now.
Mm-hmm.
Gold, though, saw a nice little bump, up over 0.5%.
Right, that's a pretty classic move for gold, isn't it? When the dollar eases up and real rates dip.
Textbook, absolutely.
So maybe for our listeners, can you quickly break down what real rates are and why they matter so much for gold?
Great question. So real rates are just interest rates after you subtract inflation. So if inflation's running hot, but the interest rate you get on, say, a bond is low, your actual return, your real return can be negative.
Right, you're losing purchasing power.
Exactly. And gold doesn't pay interest, so it looks more attractive then. It's seen as holding its value against inflation, and it doesn't have as much competition from those low-yielding bonds.
Makes sense. And copper.
Copper was down just slightly, but it's still pretty high, remember, after that 50% U.S. tariff threat we've been tracking.
Yes.
Really shows how sensitive it is to trade policy news.
Okay, so it's definitely important to connect these commodity moves back to, well, the bigger picture with the Federal Reserve.
Definitely.
The latest FOMC minutes, they reaffirmed that 4.25% to 4.50% target range for the main interest rate. Maybe quickly explain the FOMC and what those minutes suggested.
Sure thing. The FOMC, Federal Open Market Committee, that's the part of the Fed that actually decides on interest rates.
Got it. the decision makers.
Right. And their minutes are like detailed notes from their meeting, giving us clues about their thinking.
So what were the clues this time?
Well, what's interesting is that Fed funds futures, basically, where traders bet on future rates, they're now pricing in about a 70% chance of the first rate cut happening in September.
Wow, 70%. That's up quite a bit.
Yeah, it jumped from 56% just the week before. Now, even though there's been some, political noise, officials have signaled no immediate changes regarding the Fed chair.
Okay.
But our teams read on this that continued strength in things like retail sales, plus a dip in jobless claims. It actually argues for the Fed to be patient. Don't rush the cuts.
So hold off for longer.
We still think maybe 2 small cuts later this year are possible, but that really depends on core PCE inflation continuing to cool off.
And core PCE, just to remind everyone, that's the Fed's preferred inflation gauge, right? Looks at spending but strips out food and energy.
Exactly. Gives them what they see as a cleaner signal of underlying price trends.
Okay, so patience from the Fed, but definitely not patience elsewhere, especially in digital assets. Bitcoin hit another all-time high recently.
Yeah, it did, fueled by just incredible spot ETF inflows. $1.18 billion in a single day recently.
Wow.
And we've now seen, 11 straight days of net inflows into these ETFs. That totals a massive $54.4 billion overall.
It's huge. What percentage of Bitcoin is that?
It represents about 6.5% of the total Bitcoin supply now held in these ETFs.
Incredible institutional uptake.
Oh.
And Ethereum. That outperformed Bitcoin this week, up nearly 4%.
Yeah, ETH had a strong week. And XRP also surged, almost 13%.
Okay, so what's behind this big push in digital assets beyond just the ETF money? You mentioned XRP too. Why the big jump there?
Well, a huge part of this, beyond those flows, is a major regulatory tailwind bill.
That's a regulation piece.
Yes. The House just passed 3 really significant crypto bills. You've got the Genius Act for stablecoins setting rules for dollar-pegged digital currencies.
Okay.
Then the Clarity Act dealing with market structure, how assets are classified and traded.
Right.
And the Anti-CBDC Act, which basically says the Fed can't issue its own digital dollar without Congress signing off.
That's a lot of legislative movement.
It is. And the stablecoin bill is actually heading to the president's desk. That signals real bipartisan momentum for finally getting a proper crypto framework in place.
And the implication of that.
It's massive strategically.
Yeah.
Regulatory clarity significantly lowers the perceived risk. That should just keep encouraging more big institutional players, the large financial firms, to get involved.
That institutional adoption really feels like the key theme lately.
It absolutely is.
So given that optimism, what's the general thinking, the tactical view from your desk on how listeners might approach digital assets? Not specific advice, obviously, but the philosophy.
Good way to put it. The general philosophy is maintain a core Bitcoin position. Maybe look to add a bit more if we see temporary dips or pullbacks.
Okay.
For Ethereum, the thinking is similar. Look for chances to increase holdings on dips, anticipating continued growth, especially with the potential approval of an ETH ETF down the line.
Right, the ETF buzz.
And also the income you can get from staking ETH. It really reflects conviction that these regulatory steps are reducing uncertainty for the big money.
Makes sense. Conviction driven by clarity. Now let's switch over to the forex markets. The dollar's movement is quite interesting, right?
It is.
The DXY index that measures the dollar against other major currencies, it slipped back down to 98.26. Testing lows we last saw back in May. What's causing that softness?
Well, the dollar's recent weakness seems mostly due to some traders taking profits off the table.
Okay.
And maybe a slight easing in near-term inflation worries. But, and this is important, that resilient U.S. economic data we talked about, especially the strong retail sales,
Yeah.
that's keeping the dollar bears, the people betting against it, pretty cautious. They're not going all in on a dollar collapse.
Oh, a bit of a pullback, but maybe not a reversal.
That seems to be the view. For other currencies, the euro got a bit of a bounce, but it looked more like an oversold recovery driven by the dollar's dip rather than any real fundamental strength in the eurozone.
Okay. And the yen.
Ugh, the yen. It continues to weaken against the dollar, getting close to that psychological 150 level.
Why is that still happening?
It's largely down to carry demand. Investors borrowing cheap yen to invest in higher-yielding stuff elsewhere. Plus, the Bank of Japan is sticking firm to its yield curve control policy.
Right. And yield curve control, just quickly, that's the BOJ actively keeping long-term Japanese interest rates super low, right?
Exactly. Makes government borrowing cheap and discourages bets against their bonds. It's a unique policy.
So given all that, what's the strategic approach in FX? Be nimble,
Pretty much. Be strategic. For instance, maybe consider shorting currencies like the British pound on rallies if the news flow stays negative.
Okay.
And perhaps look for chances to buy the Swiss franc against the dollar, as it tends to lag when you look at real rate
Oh,
differences.
interesting.
The general view is maybe use any dollar strength, any rallies, as a chance to potentially trim some dollar exposure. That rate hike premium the dollar had earlier seems to be fading a bit.
Okay, that's helpful. Now, speaking of complex situations, let's touch briefly on geopolitics and trade. President Trump raised tariffs to 30% on EU and Mexico goods starting August 1st. This followed earlier moves on Canada and Brazil.
Yeah, more escalations.
And the EU is apparently drafting a big retaliation package.
This sounds worrying.
It does on the surface.
But the desk assessment seems to suggest markets are mostly discounting rollbacks through negotiation. Why aren't markets more spooked by this?
That is a crucial question, isn't it? It feels like a classic case of markets trying to look past the immediate headlines, the noise.
Okay.
Historically, these big initial tariff threats often end up being bargaining tools, starting points for negotiation, rather than the final word leading to all-out trade wars.
So they're betting on talks.
They're betting on de-escalation through talks, yeah.
Mm.
Or they're relying on the underlying strength of company earnings and consumer spending to kind of absorb some of the hit.
But what could change that view? When would markets start taking it more seriously? The real test will be earnings season. If companies start issuing negative guidance, specifically saying these tariffs are genuinely hurting their supply chains or their profits more than expected.
Ah, the proof in the pudding.
Exactly. That's when the market's view could shift quickly. So the advice is really monitor that supply chain commentary very closely in the upcoming earnings calls.
Absolutely critical.
Mm-hmm.
And looking ahead, we know bank earnings mostly beat expectations thanks to trading revenues. Next week, eyes are on tech names like NVIDIA, right? For insights on China AI chip demand.
Yep. NVIDIA, and also ASML, the chip equipment maker, for any comments on how these escalating tariffs might impact the global tech supply chain.
Okay, so all of this feeds into the broader strategic thinking, the takeaways for you, the listener.
It does. Let's try and tie it together.
So in digital assets.
The advice leans towards potentially increasing exposure to Ethereum, anticipating that ETF approval and maybe income from staking.
Yeah.
Still maintain a core Bitcoin position, adding on dips if those ETF flows maybe slow down a bit.
Okay. And currencies.
Consider being underweight the US dollar, maybe hedging with Japanese yen, anticipating the Bank of Japan might step in with words if the yen gets too weak.
Verbal intervention risk.
Right. And generally, maybe think about some modest protection against potential disappointments in Eurozone growth, or if the dollar rallies again once this Fed rate cut excitement eventually cools down.
Got it. And finally, portfolio hedging. Any thoughts there?
Yeah, there's a recommendation to maybe increase gold allocation, sees it as a hedge against unexpected policy moves or more tariff friction.
Makes sense.
Plus, maybe think about some protective measures for your equity gains, especially since the market seems quite optimistically positioned right now.
Okay, so what does this all mean? Pulling it all together for our listener.
Right. If we connect this to the bigger picture for you,
Right.
it means the crypto market's really strong momentum.
Yeah.
It's largely about leveraging that new regulatory clarity.
Okay.
You do that through selective exposure. Think Bitcoin, think Ethereum, especially using these new investment vehicles like ETFs. The dollar's current softness. It looks more like a correction, probably not a major structural shift.
So stay agile.
Exactly. Remain nimble with tactical bets against the dollar, but, and this is key, consider ways to protect yourself. Maybe using options if the dollar suddenly snaps back stronger.
Good point. And tariffs.
Tariff escalation definitely needs close watching, but the current resilience in stocks suggests maybe preparing for some volatility rather than doing a wholesale de-risking of your portfolio just yet.
Okay.
And this really raises an important question for you to think about. How do we adapt our own perspectives to these signals that are constantly changing, often pulling in different directions? And maybe a final thought to mull over. With that higher for longer interest rate idea still very much alive, how will next week's Fed speakers and the July PMI data really confirm or challenge that view?
Yeah, what will that data tell us?
And based on that, what adjustments might you consider for your own investments that are sensitive to interest rate changes?
Fantastic points to consider. Really appreciate you breaking all that down.
My pleasure.
And thank you, everyone, for joining us on this deep dive into the global markets and digital assets outlook. Keep learning, keep questioning,
Still curious.
and we'll catch you on the next one.